Cost accounting, chapter 3, deals with cost, volume, profit analysis. All of these concepts should be reviewed from managerial accounting because we covered all of them basically in that class. So they abbreviate it CVP, so the cost, volume, profit analysis. So in there, we look at their revenues and their volume, like how much do they need to sell to break even, how much do they need to sell to have a targeted profit, and then we go through, again, they'll give you these formulas. I kind of do them a little bit differently when I do them, but again, these formulas are fine, and I don't normally write them horizontally either, but if you like how they do it, that's fine. But so I do it more like this top way. So our total revenues minus our total costs gives us our operating profit. And then our total revenue may have to be found by taking our selling price per unit times our number of units sold. So sometimes they'll give you the total revenue, sometimes you've got to compute it. And then your total cost has two components. So there's a variable piece, a piece that increases with every unit you sell, and then you add the fixed costs to that. So again, they're kind of just showing you the formula, again, a little bit differently, but it's still that total revenues minus total costs, but now they're substituting in those different formulas. So to me, sometimes though, like this looks confusing and they make it a little more confusing when they set it up like that. So I wouldn't worry about it too much like that. The contribution margin is your selling price, your price per unit, minus your variable cost per unit. They could also give you that in total, like your total selling price minus your total variable costs. So here we have an example. They give us the price, it's $4,000 per trip, 55 trips gives us our total selling price or our total sales. Then we have our variable costs. They have it broken down into two different types. So maybe these are, say, like direct materials and direct labor, and this is your variable selling. So sometimes we have those separately. And then we calculate out our contribution margin, less those fixed costs gives us our operating profit. So then our break-even point, again, I'm going to go down to what's here in the words, is our fixed cost divided by our unit contribution margin. So if we go back to that one, the fixed costs are the 134,400, and then our contribution margin, if you took the $4,000 selling price per trip minus $900 minus $300 for the two different variables, that gives you the $2,800. So then you take your fixed costs divided by the unit contribution margin to get your number of trips that you would need to take to break even. Now then, what if we don't have the per unit? So sometimes the problems do not have that per unit price and you can't calculate it. So then you can use the contribution margin ratio. So then your contribution margin dollar amount divided by your selling price, right? Is that, let's go back there real quick. Yes. So that contribution margin dollar amount divided by your selling price gives you a percent. So then you could take your fixed costs and divide it by that percent to get to the sales dollars that you would need to break even. Again, you would do that if you didn't have the per unit costs available. But many times, obviously, companies are in this to make money. They're for profit. So they want to have a target profit that they want to make. So then now if you want to make $70,000, how many trips would you have to take? You still have to cover all your fixed expenses, plus you want to make $70,000. So then you take those two, add them together, and then divide it by the unit contribution margin to get to how many you need to sell. Again, if you didn't have the unit contribution margin, you could then divide it by that 70%, that contribution margin ratio. So then again, here are the formulas if you have it in units, or again, if you don't and you just have it in sales dollars. So those are kind of important to jot those down. Same thing with the target profit. You're just going to add that target profit divided by the unit contribution margin or divided by the contribution margin ratio, again, whichever you have. And then they do like you to look at this graph, and I think I have that in the homework where you fill in the blanks as to what it is. So some people like to see it graphically, but you want to be able to kind of read through those to say, like, okay, you know, where your costs, where your sales meet that point where it costs, where it covers all the costs, that's your break-even point. Then if you're below that break-even point, anything in there is going to be a loss. Anything above there is going to be a gain or income, a profit. Then our cost structure is the mix of how much are our fixed costs versus our variable costs, because sometimes we can't really change that cost structure, at least in the short run. In the long run, you can always change a cost structure, but in the short run, you might be somewhat fixed with what your fixed expenses are, like for the next year or whatever. And then your operating leverage is the extent to which those cost structures are compromised of the fixed costs, again, because those are the ones that are a little bit harder to change. So our operating leverage formula is our contribution margin divided by our operating profit. And then our margin of safety is how much our current sales volume is over our break-even point. So if our current sales is 55 trips, our break-even point was 48 trips. The difference between those is what they call the margin of safety. Now then you can have it, this gets it a little bit more complicated, but it's actually probably more realistic. Obviously, companies don't normally just sell one product, they sell different products. So with this example, not only do they have rafting trips, but they have excursions, or they have excursions. That was the one we were doing before. Now they also have rafting trips. So then the rafting trip has a different selling price, has a different variable cost, and a different contribution margin. But both of these are going to help us cover those fixed costs. So then what would be our contribution margin of the mix? So let's, again, go back there. We've got the 4,000 and the 500. Are our two selling prices. Oh, sorry, those are not our contribution margins. The 2,800 and the 400 are our contribution margins, and we are taking the number of trips that we sell times each one of those to get to our total of $100,000. And then, so what would be our weighted average of that? So the 25% times the 2,800, 75% times that 400, our weighted average contribution margin then would be 1,000. So again, the one is higher because it's a higher price, and then the other one obviously is the lower price. Okay. So then here they've got the break even calculated out then in dollars to say, okay, we have 144,000 fixed costs that we need to cover at our mixed contribution margin of 1,000. So that's 144 units. And then they show it to us again, calculated out down below. If we did our weighted average for the two, then we would have a different percentage there, right? Is that the same? Yeah. So then now if we're doing a weighted average of that, then we've got a different contribution margin percentage that is calculated out. And then we use that to calculate out our break even in sales dollars So then that would go up to 198,000 versus no, it's the same. So I guess they're just showing us a different calculation, right? Because we're getting the same answer, the 198,000 break-even point. All right, so then now we have, again, if there's changes in our fixed expenses, because again, our cost structure is what's the fixed versus the variable. So if our fixed costs are sufficient for monthly volumes less than or equal to the 40 excursion trips, for every additional 40 trips, they must rent a machine for $19,600 per year. So with that increase in fixed costs, they would have to sell more, to break even. So then, because then now if they only did the 48 units times the unit contribution margin, and then now our fixed costs increase, we're going to be losing money. So then we have to sell more to cover those additional fixed costs. So then now again, our break-even point goes up. We've got to cover the additional fixed costs. So now we have to do 55 trips. So then, while this is a tool that you can use and you can apply some different assumptions to it, the assumptions are that certain cost remains fixed and certain costs are variable. That's kind of the main key to this particular. And maybe sometimes, like we've talked in past chapters, that we could have semi-fixed cost or step costs. So those may make it a little bit harder to use this cost volume profit analysis.